then
Okay.
I'll show some adjustments.
All right.
Okay. And once again, just a reminder, I'm giving away the very best parts of the system. Okay, perhaps I shouldn't say that up front if I'm trying to sell you a book, right? Hey, look, the very best part I'm giving away. All right, but the fact is true. The idea of limiting your risk to single-digit percents up front is the most important part of what I do.
Mm-hmm.
Now, the 10 adjustments, the 10 income methods that take a trade from low risk to no risk, well, that's all in the blueprint. We're going to show 2 of the 10 income methods today.
Okay.
But again, the very most important part I give away, and it's important if you're not happy with your trading results now, that you pay very close attention to the next few frames. Okay. Just before we do those next few frames, I'm just going to ask the question: are you happy with your trading results? Okay. Let's take a quick poll here. Okay. Yes, no, or you have mixed emotions.
Mm-hmm.
And Mike, this is shaping up about the way they normally do. Even
Okay.
though we've had a pretty successful run over the last 12 months, I mean, hasn't the market been good to us over the last 12 months? Has it been
Oh,
good
absolutely. Yeah. I mean, we've seen a lot of stocks that were down at $4 that have moved up to 16. You know, we look at Ford. I think it dropped down at one point to $1 per share, and now it's up near 8 or 9. So there was a lot of potential to make money. But as you mentioned, Kurt, the biggest problem that a lot of investors suffer is they don't understand about limiting risk, or they give back to the market most of what they had already made.
you? That's right. I'll be doing a live seminar a week from today in Colorado Springs. And the last time, we're going to do a little game there.
Mm-hmm.
And the game is a winning proposition. What that means is we're going to set folks up with some chips that they can bet, you know, just poker chips that they can bet, and I'll guarantee them 6 wins out of 10.
Mm-hmm.
Now, with a guaranteed 6 wins out of 10, managing money correctly, you're going to make money. Isn't that right, Mike?
That's right. If I have the proper position set up, or I take the proper risks, I can make money. Absolutely.
Right. But even so, I mean, you saw this when we did a seminar over there on the East Coast. Some people went broke. They didn't just fail to make money; they went broke. you
Right.
know, And thankfully, it was just poker chips. Okay. All right. So the market's been good to us, and yet, Mike, let me go ahead and share the results of that poll just now. Look, this is dismal. We had 6% say yes, I'm happy with my results over the last 12 months. We 35% just coming right out and saying no, and then 59% saying mixed emotions, which, Mike, as we have learned, is code for no. Isn't that right?
That's right. If I was happy with my trading results, I would have said it. And we're not poking fun at anyone, because no one knew more about mixed emotions than you, Kurt, when you first started trading covered calls after you took that weekend class.
That's right. I took a weekend class. It cost me $3,500, and of course, coming out of there, I had to be an expert, right, on risk,
sure.
and well, that wasn't how it worked out, and I did lose almost all of my life savings. Okay, so if you have mixed emotions, look, I understand. Okay, but let's call it what it is. Mixed emotions means no, I'm not happy with my trading results, but it's easier to say. Okay, so we have, Mike, essentially 94% of our audience is saying, no, I'm not happy with my results from the last 12 months, and then 6% are saying yes. I'd like to congratulate all 3 categories. I'd like to congratulate the folks that said yes for beating the market, and the folks that said no or mixed emotions. I'm going to say congratulations, because you're in the right place to learn how to solve that problem once and for all. Okay, let's go ahead and take a look at the radioactive profit machine, Mike. Okay, this is what I call the 5 lines, and it's a setup. Now, Green Mountain Coffee Roasters, I've made money every time I've played it. But well, yeah, and you have too, haven't you? You followed me into this particular trade that I'm showing.
That's right, I did.
With Green Mountain Coffee Roasters, okay, I am not endorsing Green Mountain Coffee Roasters as my pick. I'm not, one of the things I like to say, Mike, and I've been saying since 2002, is don't pick stocks, pick stops. Make it so that you can only lose a very, very small amount if you happen to be wrong. But if you happen to be right, leave the upside open. Okay, that goes along with that old trader's maxim of cut your losers short and let your winners run. Well, how is that done? How do you accomplish that? Well, here's one way. Let's take a look here. The Green Mountain Coffee Roasters was trading at 54.20 when I picked it up on April 22nd last year.
Mm-hmm.
At the same time, I bought 2 September $65 put options for $16.70. That makes a total investment of $70.90. Now, Mike, this is different from a regular. First of all, what kind of trade would you call this?
Well, it's a married put trade, but it's a unique setup. If you've ever read any information at your broker or some free education that describes the strategy of the married put, it's usually described as buying stock and buying an out-of-the-money a put that's below the current stock price just 1 month out in time. So you pay a small price for that insurance, but the stock still needs to drop before the insurance policy kicks in. So you still might be risking 15 to 20% on the position, which is an unreasonable amount to take on a risk on a given position, isn't it, Kurt?
Right, it is for me.
Mm-hmm.
I'll never take more than single-digit risk on any position that I open. Well, anyway, let's take a look here. With the total invested of $70.90, Mike, if that stock goes to $72.10 with a traditional married put, and my cost basis being $70.90, what do you think my profit would be?
Well, your profit would only be $1.20, wouldn't it, Kurt?
That's how a traditional married put, with near expiration, would pan out. But that's not how I ran this. Okay, Mike, what I did was I spent $16.70, sure enough, but I'm guaranteed to get most of that back, and it's because I bought that in the money and far out in time. Let's take a look. The total invested is $70.90, but I have a guaranteed exit, don't I?
Mm-hmm.
Of $65. At any time before expiration, and that's 5 months away, I can choose to exercise my put, or I can sell my stock and my put separately, and I'm going to definitely get at least $65 back. Okay, so the at-risk amount really is only the difference between my total investment and my guaranteed exit, which is $5.90. Now, $5.90 against the $70.90 that I've put in is a small percentage. It's 7 or 8%. I forget exactly. You could work it out by dividing the smaller number by the larger number, and that's how you'd find out. I think it's 7 or 8%. But here's the point, okay? When the stock goes to $72.10, what did you say my profit should be?
$1.20, wouldn't it?
Well, that's what you think, okay? But let's go ahead to that's what you might have thought. Not anymore, right? The stock did go to $72.10 8 days later with the earnings announcement, okay? And it gapped up. Now, if it gapped down or just didn't perform at all, I would still have 5 months to hold on if I wished and still only be risking 7 or 8%, or I could get out with a small loss,
Mm-hmm.
all right? But here's what did happen. The stock went up to $72.10 and I sold it. By the way, the September put options still had some value. They don't go to zero just because the stock goes up above that strike price. Because they were far out in time, they became 100% time value. And at this point, I just sold them. I didn't apply any income methods. Up here it says Green Mountain Coffee Roasters radioactive profit machine closed, no income methods, right?
Mm-hmm.
Okay, so 8 days into this trade, during a live seminar, I was in Monument, I think, at the time, doing a live seminar and live during the market, and I closed this for an over $2,000 profit in 8 days. Mike, what happened was the total for closing this radioactive profit machine was $81.80, but the total invested had only been $70.90, so that's a profit of $10.90.
Mm-hmm.
Now, had I been wrong, what was my maximum risk? Well, it was $5.90. Let's take off the 90 off of both of those, and let's just say 5 and 10. Okay, let's say I've risked $5 and or I could make $10. Mike, if you were to flip a coin all day long, and every time you got heads, you lost a nickel, but every time you got tails, you made a dime. Gosh, would that be a good use of your time? I'd probably want to flip quarters. I'd probably flip quarters with both hands.
Mm-hmm. Absolutely.
All day long, yeah. And so that's the idea, is to skew your risk and your reward using the radioactive profit machine. If you're wrong, you lose little. And if you're right, you have the potential to win pretty big. Okay? All right, so that's the starting place, Mike. And I'd like to take maybe a couple of questions from our audience before we go on. Okay?
Okay, well,
While those questions are loading up, okay, let me just ask everybody, hey, what single thing, look at this list of 5 and think very carefully, but what single thing from this list do you think you need to be more successful at trading? We had, after all, Mike, we had 6% say that they were happy with their trading from last year, 94% unhappy with their trading, or less than happy, right?
Right.
What single thing do you think you need in order to solve that problem, in order to be a better trader? And even the folks that said that they were happy with their results, they can participate in this poll, can't they?
Oh, sure.
Yeah, because what could you be doing to be happier? Okay, let's go ahead and take a couple of questions, and then we'll show the results to this poll.
Well, Raj had written in, and he just said, so it is possible to start seeing a profit even before it reaches the strike price of the put, isn't it?
That's correct. Yeah, you can make adjustments. The day after I bought Amazon, a couple of years ago, I bought Amazon and also bought a put option. The day after, Amazon went up, and the put option, Mike, also went up. Interesting. Why do you think something like that might happen?
Well, and that was a unique situation, which Ernie has experienced before, but as Amazon started to move up, the implied volatility increased, and that inflated the option premium, I'm assuming. So you got benefit of both of those positions. You got an increase in the put and an increase in the stock.
Isn't that something? Okay. A lot of folks just don't understand put options, and it's my mission, if you will, to help reverse that situation. I think more people need to understand how to use puts to limit their risk, and also how to use puts to profit. We're going to take a look at manipulating a put option here in just a few moments, so that you guarantee yourself a profit, and that's kind of interesting. Okay? All right, Mike, I'm going to go ahead and share these results. All right? 7% believe they need to spend more time selecting stocks. Okay? But as I said before, don't pick stocks. What did I say?
Pick stops.
Yes, okay. And then 20% say a more reliable system for timing my trades. What's my famous saying there, Mike?
Don't time trades, trade time.
That's right. We're gonna take a look at how that works here in just a moment. Okay. All right. The winner is what? Limit my losses more. Okay. And another idea is, geez, maybe I'd like to make my wins bigger. But I'm going to say that that limit my losses more is probably the very best indication here of what needs to happen. And on some level or another, about half of our audience already knows that, right?
Oh, yes.
Okay.
Yes.
Yeah, a little later on, we may get a chance to take a look at the Trade Simulator tool and demonstrate in vivid color how big of an effect limiting your losses can have. But first, let's take a look at what's different once we put together the radioactive profit machine. Okay, Mike, are we back on my screen?
Yes, and we have what is different now, section number 4.
Okay, I skipped a couple of sections so that we'd have time to do some other things today. Okay, but here's the difference. When you trade radioactively, you begin at a place where your risk is limited to a very, very small amount. Okay, it's called forced ideal size trades. Forcing yourself not to get in too big of a pickle. It's the exact opposite of what I did when I lost everything. When I lost everything, Mike, I had bought stock, sold the covered call against it, so I was obligated to hold on to the stock, and I did it all on margin, which means I borrowed half the money to do the trade. Well, when the stock opened up the next day at half the value, I had bought it at 17, and it opened at 9 and was going down from there. What do you think happened to my account?
It went down as well, didn't it?
Yeah, it went to zero. My broker called me. At the time I was using a full-service broker. My broker called me and says, hey, Kurt, I've got a margin call. What do you want me to do? I was like, sell it for as much as you can get. He says, well, I can't enter an order like that. What
Mm-hmm.
what do you want me to do? Limit order, stop order. What's going on? Oh my gosh, what a nightmare of a day. Well, anyway, that never happens to me anymore. I begin at a place where my risk is limited to single digits. Okay, 6-7%. All right, and then that place becomes a platform from which I'm able to launch other trades that would normally carry risk but don't. For example, Mike, we're going to take a look at a bear call spread that has zero risk.
Mm-hmm.
Can you imagine that, or could you imagine that before you started looking at the radioactive system, a bear call spread that has zero risk to it?
Yeah, that's pretty amazing, isn't it? Especially the spread traders, they'll appreciate that. I'm very sure.
I certainly will. Okay. And then, of course, there's 10 different ways of doing this. Okay, 10 different income methods that, it's more than one tool for your bag, more than one arrow for your quiver.
Mm-hmm.
Most folks that are familiar with options know how to short calls, so that there's one tool, and that's about it. Okay, because that's about what they can cover in a weekend. Well, with the radioactive trading method, there's 10 different ways to adjust a trade to either take out risk or take a credit, take income, or do both. And 9 of those ways take money out without adding any risk. This particular method that I'm going to show, income method number 4, puts in more money, but it takes away all the risk. And we're going to share that, and then we'll also share that bear call spread that I mentioned. Okay?
Okay.
And here's a classic example now. You've seen me do this twice in the last, 7 to 10 days, haven't you?
Mm-hmm.
You've seen me use income method number 4. All right? But I like to use this classic example because at the time, a gentleman that's now a fan that used to be a critic of mine was criticizing this method of trading. And while we were having this debate, I actually posted this up on their blog, and as far as I know, it's still there.
Mm-hmm.
I posted the trade as I was making it. So I like to use this example. Mike, here's how it went down. On September 25th, 2006, I got into DIA. This is my DIA radioactive profit machine. I bought shares at 115, and at the same time bought a January 07 $119 put option for $5. Well, that makes our total invested $120, and the put guarantees me what?
Well, it guarantees you $119.
Yeah. So the amount that's at risk is the difference between those two numbers, which is $1.
Mm-hmm.
Now, Mike, looking at this put option, what can you tell me about it? What can you tell me about the premium and its pricing?
Well, it's $4 in the money, so it has $4 of intrinsic value. The total price is $5, though, so you have $4 of intrinsic value and $1 worth of time premium.
Okay. Now, when we did the poll earlier, nobody said options me no likey. So I'm assuming that almost everybody understands the difference between in the money and out of the money. With the put option, it's a little different than with a call, for example, but 119, and the stock is priced at 115. The put has to be worth at least $4. But the other dollar that's in there is the time value, and that's the only thing that's at risk. It's just the time value. Now let's remember this. Let's remember that the time value is $1. And let's see what happens. Okay? 24 days after putting this together, the stock goes from 115 to 120. Now, Mike, that's not a very big move, is it?
No, it's a 5-point move. It's less than 5% of the underlying stock price. So it's not a big move at all.
Yeah, it's not like something really dramatic had to happen so that I could do this income method. But something did have to happen. It did have to go up a little bit. Now, the $119 put option had been priced at $5, right?
Mm-hmm.
Well, it fell down to $2.05, which is a loss of the difference. It's a loss of $2.95, correct?
That's right, Kurt. You've declined $2.95 total value on that put option.
Yeah, and my critics will point out, they'll say, well, listen, Kurt, why do you even buy the put? Because now, the stock has gone down. Well, listen, if the stock can go up by $5, can it also go down by $5?
Of course it could.
Yeah, and my loss would be how much? $5. All right.
No, not in this case.
Not with my put option. That's right. It would be $1. So that's kind of a or less.
Mm-hmm.
So that's kind of a nice net to have underneath me. Something to help me sleep at night, and certainly something to buffer my account if a black swan event happens, like oh gosh, like a market crash or 911 or something like that. Okay, all right, but nevertheless, folks will look at that and they'll say, well, look, Kurt, you lost $2.95. Well, not exactly. You see, Mike, if I was to take $2.95 out of your wallet and pay for a latte at Starbucks, would that be okay with you?
Well, I mean, I'd be curious as to why you just took it right out of my wallet without asking me. I might be a little bit put out on that.
Well, I wouldn't be very polite, but if I'd have handed you a $5 bill and say, hey, thanks, I just wanted exact change for this, you know, so they don't expect a tip or anything. So I take the $2.95, but I also hand you $5 at the same time. Would that be okay with you?
Oh, yeah, I'd be quite all right with that.
Yeah. Okay. So that is what happened. The stock had to go up by $5 for the put to go down by $2.95, and that's okay. But let's look at something very interesting here. On the previous page, we know that the time value of this put was $1, right? On the previous page, the time value of the put was $1, but now the time value is $2.05. Hey, look at that. The time value more than doubled. And like I say, don't time trades. Trade time. This is something I do after the fact. I have no idea what the stock's going to do next. What I do know is that now Income Method 4 is available to me. And here's what I did. I bought to open the January 08 $128 put option for $9.70 and simultaneously sold the January 07 $119 put that I already owned for $2.05. And that gives me a total debit of $7.65. Now, I realize that this doesn't look like income, does it?
No, you're paying a debit into the position. You're adding more into the cost basis, aren't you?
That's right, but relax because I'm guaranteed to get it back. Now, I should mention that out of the 10 income methods, this is the only one that's done at a debit, okay? But it is being done at a debit, but let's see why, okay? Let's see what happens, okay? By doing the spread trade, and by the way, this is just one commission at my Options Express account, okay, to roll this put like this, okay. My original position had been DIA shares for $115, the January 07 119 put for $5. So my total invested amount is $120 so far, correct? Now by rolling that put, which has had that interesting time value phenomenon increase, okay, now I've added $765 into my deposit, into what I've put into this trade. So that's a total of $127.65, right? Okay, so everybody's tracking. What is the value of the put option that I rolled it to?
Well, you rolled it to a 128 put. So you've got a total invested of $127.65, but you're guaranteed to get $128 back. So you're now guaranteed a gain of 35 cents, even if the stock drops from here.
Right. I've got it's bulletproof is the way that I like to say it. Okay, bulletproof means that I can't possibly lose anything, but that the upside is still wide open. Okay, and let's point something else out. We used to have a January 07 put, okay, so on October 19th, 2006, there was 3 months left in the trade. So 3 months for that stock to develop in price, right?
That's right.
But now there's 15 months for that stock to develop in price. Now, two things I should mention. Number one, DIA pays a dividend, and that's free and clear above and beyond this 35 cents that I'm guaranteed to get back, right?
That's exactly right.
Right. Here's the other thing I should mention. This is where I did all the activity to make this stock bulletproof, and this is what the stock did over the next 15 months. And during this roller coaster ride, Mike, can you see some opportunities for me to apply income methods number 5 and 6?
Absolutely. The money nets, as you like to refer to them, where you could have caught extra premium in addition to the credit you receive.
Right. Now today, we're not going to share income method 5, but I will share income method number 6. Okay? Do you think folks are ready for that?
Absolutely.
Cool. Okay. Just before I do that, I'm going to run a poll again here, Mike, and because only 6% of our audience said that they were happy with their trading from last year. I'm going to say with what you've learned so far, okay, about how to limit risk by buying a stock along with a put option, would it be different? Would you have a different picture if you had been here a year ago and was able to keep your wins down to, say, 6% or less? Okay, if you could keep your wins from last year, but keep your losses down from whatever they were to 6% or less per position whenever you did lose, okay, would that have changed your answer? Would you have said, yes, I'm happy with my trading results? Would you have said no but been closer to yes, or would you have still said no, or mixed emotions? Because I consider those answers to be the same. We've got lots of folks running in there to vote. Mike, do you have any questions that have come up that you think would be good for the whole audience?
Raj just asked again if Power Options will be able to find the bulletproof trades, and the answer is yes in two different ways. One, if you're tracking one of the RPMs in the portfolio tool and you link to the analysis screen after the stock has moved up, we will calculate for you potential income methods, and if you see an income method on that analysis page with a negative at-risk amount, you can bulletproof the position. That means that it's bulletproof, just as we just saw there with the DIA example. And also, if you're holding a stock that has moved up in price, or you might get stock from your work at a discounted price as part of a benefit package, we have a unique tool in the Married Put section called the Insurance Tool, which will show you puts that you could buy right now that might be able to bulletproof your stock based on the increase that you already have. So if you have an increase of 15%, it'll calculate for you put options you might be able to buy where you're going to lock in for the next 6 to 8 months, let's say 8 or 10% of that 15% gain, and still have an unlimited upside profit potential.
Isn't that something? Well, good. Mike, here's the results of that poll. 44% would have said, yes, I'm happy with my trading results. Mike, is 44% better than 6%?
It's much better. The Magic 8 Ball says, yes, that's good, yes.
Okay. And 44% more would have said no, but been closer to yes. So essentially maybe their expectations of what they could make trading would not be met, but they certainly wouldn't have lost as much, or they certainly would be better off, right? Okay. And then 13% would have still said no or mixed emotions. Well, I'm going to suggest that if you are risking less than 6% per trade and you're still not happy, you're probably over trading. Okay. Because that implies to me that we said if you kept all your wins but you kept your losses down to 6% or less, then if this 13% that is answering no, they must have risked less than 6%, huh?
Yeah.
Yeah, and so they may be over trading, Mike, or they may have an unreasonable expectation of what they can get out of their trading account. Geez, I've got $10,000 and I can't live off of it. Why not? Well, that's just not enough capital. It's not enough capital to just live off of.
But many people are also told the wrong thing. Many people are told, I can pay me $3,000 and I can teach you this unique covered call method that will earn you 6% per month. And if you sort of compound that, you can make 100% per year. Well, it doesn't really work that way. And many people found that out, and that's the goal here, is because they never address the downside, and that's what we want to address to keep you in the game longer, to keep more of your hard-earned money still in your account and not risk it for something you can't control.
That's right. Mike, I never make claims like that. I never make a claim of a monthly return. What I do tell folks is, look, this is the most you can lose. And that's the only honest thing I can tell them, isn't it?
That's right. That's exactly right.
This is the most you can lose, if you're happy with it, take the trade. If you're not happy with it, don't take the trade. And that's kept a lot of folks out of trouble, and it's also made a lot of folks money, because the other side of it is you can be unlimited in your upside potential. Okay? Now, Mike, I bet you we lost a couple of people on that last comment. I bet you a couple of folks said, oh, I can't make 6% per month. I'm out of here. Okay, well, actually, Mike, last month I made 11.2% on a trade. Is that okay?
That's okay.
Yeah, that's fine.
That's better than 6, isn't it?
Yeah, it's better than 6. But I don't make any kind of claims that I'm going to do that all the time. Okay, I don't make claims that I'm going to do 40% all the time, although that's happened to me.
Mm-hmm.
So, all right, let's go ahead and, Mike, let's show that, let's show that riskless bear call spread, okay?
Okay.
Oops. Oh, my goodness. I don't know if I want to do that. What did I just do? Huh. Are you seeing what I'm seeing on the screen there, Mike?
Well, yeah, it says it's trying to open the radioactivetrading.com website from one of your slides.
Oh.
Just click, yeah.
No. And see what she says. Okay. There we go. All right. Can you see what it says up there now?
Yep.
Income strategy for buy and holders. Okay, good. Now I do some coaching. Okay, and I had one fellow that wrote to me that he was holding shares of McDonald's. Okay, and I ran some numbers. His cost basis was just $22.15, and at the time, McDonald's was trading over $60. Okay.
Okay.
And I thought that was pretty cool. Now, Mike, here's the deal. With selling covered calls, I call it plain vanilla. Okay, when you're selling covered calls, you're able to bring in a little extra income, right?
That's right. Mm-hmm.
Okay, but are you able to leave your upside open with that option?
No, our upside is absolutely capped. We can't make more than the premium we received and the strike price of the call itself. We're not going to be able to take advantage if the stock really takes off.
Okay, but this fella, he would like to bring in his income. Okay, he'd also like to leave the upside open. And here's another thing. Can covered calls do this, or can long calls do this? Can you make the position bulletproof to where you can't possibly lose anything?
Well, with covered calls, we have people who have before written in and said, yeah, I've been trading covered calls for years, and I've paid off my stocks with the premiums I received. Well, how long did that take you? Oh, 10 years. Okay, well, that's good,
Right.
but, you know, it's a long, long time horizon, isn't it?
Yeah, that's a little too long for me. I think I'd rather do it right away. Like, for example, my Netflix position, which is completely bulletproof, I bought... Gosh, didn't I buy it this month? Or if I didn't buy it this month, it was toward the end of March.
I think it was around,
so
yeah.
Yeah, Netflix has earnings coming up. I'm totally bulletproof. I can't lose anything. I'm guaranteed to make 2.6% at least. And I'm pretty certain I'm going to do better than that, Mike. But the fact is that happened in a matter of just a few weeks. Okay, same thing with CRE, my CRE position. Okay. Well, anyway, we'll talk about bulletproofing more. Here's the most popular way to take income, and that is to sell a covered call. But as we know, that's not going to fit the bill for our subscriber, okay, because it caps the upside.
That's right.
Okay, and it also leaves you potential for loss. I mean, even with McDonald's at a very low cost basis, okay, where he had got it at $22.15, even so, he still has the risk that goes along with owning stock, right?
Absolutely.
I mean, could McDonald's conceivably, could it go down to $5 a share?
I mean, we wouldn't expect it to, but anything can happen.
Exactly. We don't expect airplanes to hit the Twin Towers either, do we? Okay, so things happen, all right? So the covered call caps the upside, but it doesn't really protect us at all, okay? But let's try this. How about a put option, okay? A put option would be very, very cheap because the stock is way high, and if you were to insure it at just the $50 strike, okay, with a cost basis of $22.15, well, this will be bulletproof, won't it?
Absolutely.
Oh, yeah. Okay, unlimited upside, although there's no income that's coming in. Okay, so I guess that's not fun. So close, but no cigar. All right. Now, here's an idea. Why don't we do what I used to do 8 years ago? Okay, 8 years ago I began trading radioactively. There have been a couple of folks that have begun to do so recently, including one fellow that as recently as 3 years ago, he was railing against puts. He was saying, oh, geez, you should never buy a put. This is a gentleman that's pretty well respected in selling covered calls. And on his blog, he posted, hey, you should never do puts. Okay. Well, after coming to my seminar, my webinar, he did begin teaching puts. And so he's where he is right now, Mike, is about where I was about 8 years ago. And and that is that, okay, you buy an in-the-money put, you buy stock, and you also sell a call to finance it. But let's look at the risk graph and what that does, okay? It's what I call income method number 1. But, Mike, it actually makes for 2 different ways to lose, doesn't it?
Yeah, and that's really tricky because you've got to be so right. And we get this all the time. And also the bad way to do this is if you open a Married put right away and you sell a call below the strike price of your put, you'll see this chart. And, I tell customers, hey, if you're a better stock picker than me and you can pick that this stock's going to be trading right at 67.5 or right around that range in the next 30 to 40 days, hey, you can go ahead and do this. But I'm not that good, so I would never do it.
Right. Okay. Selling covered calls can erase some of your cost basis, but it can also cut into the value of your stock as it goes up because of the intrinsic value in your put going away. So that's not a really cool plan. Now let's check this out, okay? We're going to take one more shot at this. We're going to do income method number 6. Here we are with the stock and the put. Now, this bulletproofs the stock, but it doesn't take any income, does it?
No, we haven't generated any income. We've just given ourselves an insurance policy with a guaranteed exit price for a profit.
Right. Now, with the stock trading right around $65, the option premium that has the most juice to it is the $65 call. But rather than simply selling the call, we're going to also buy the next strike up call. Okay, so this 242 we collect because we sell the call,
right?
And the $1.26 we pay because we buy the call, and that makes for $1.16 income, right? Okay, let's look at the graph. Boom. Okay, now there's something missing from this graph that's very familiar that you normally see in any options play that's graphed. And what is that thing that's missing?
Well, it never drops. There's no break even. It never drops into a negative value, no matter what the stock does.
Right. Because the stock is bulletproof, you may take income on it from income method number 6. If the stock decides to go up, guess what? There's this tiny little bump here. You see that little bump there? Where you might want to manage. But if your stock goes from 55 to 75, okay, or if it goes from 60 to 70, you're going to, or if it goes from 60 to 85, you're going to have all the benefits of that stock going up, all right, and never get hurt because that long call takes over for you. You collect a credit on the front end. If, for example, the stock goes up and you're supposed to pay it out, well, guess what? Your long call is also gaining at the same time your stock is gaining, all right, and you never get hurt, okay, is my point. An actual graph of a bear call spread looks kind of drastic, doesn't it? You may have to pay back more than what you took in.
Sure.
Right? But that's never the case when it's in the context of a married put that's bulletproof. Okay,
Absolutely.
Let's take a look at the vital statistics of this. Okay, we're paying 87 cents for this put option. Okay, we're taking income by way of the bear call spread. Okay, so now our maximum risk is negative. We can't possibly lose, and we still have an infinite maximum profit. Pretty cool. Okay, now in order for this to work, okay, you've got to already have a bulletproof stock. But as I've mentioned, Mike, there's 10 different ways to bulletproof a stock, isn't there?
Yep, there's 10 different income methods, sure.
Okay, so this gentleman that had written in, he would be able, if he applied exactly the trade that I showed, to bulletproof the stock, and by using a put option to lock in the $50 all the way to January 2011, he can insure the McDonald's stock against black swans like the stock market crashing or like a 911 type event, okay? The cost of the $50 put is only 87 cents, and the June 2010 65, 67, 50 bear call spread generates more income than the put. So he's buying the insurance policy, and then he's getting the insurance policy paid for. That policy works all the way out to January 2011, but hey, this bear call spread expires in June. Is there any risk at all in this trade?
No, none at all.
Zero. Okay, McDonald's can go up, it can go down, it can go sideways. The spread is going to take income, and this is what we were promised in the covered call trading course, weren't we? We were promised that you can take an income over and over again and never worry about it going down. Well, that's not how it works when you simply own stock and no insurance policy. Okay, all right. So that's one of our combinations of our methods there, Mike. Okay, let's see. What time have we got? We've got about 10 minutes left. Are there any questions that you think we'd like to handle for the whole group?
Well, since it seemed like we had some covered call traders, and you did address this a little bit, but Rod brought up another question about, well, in that income method number 6, as the stock goes up, you're going to get assigned on the shares, aren't you? You're going to get called away because of that short obligation.
Yeah, but it's unlikely that that's going to happen before expiration unless there's a dividend X date. Okay, at the dividend X date, okay, when you're getting ready to collect a dividend from McDonald's, if that call is in the money, it might get exercised. So just before that date, you could roll that call. Now, how would you do that? Well, we call it income method number 2, where you would buy to close your near call and sell to open a further out, higher up in price call to finance it. And oh, by the way, you can sit on that long call that you still have, that you actually received at a credit. Now, that's a lot to say without pictures. But the fact is, Raj, we've got a management technique in place for that eventuality, and you would only use it if you were going to certainly be assigned, and if you're going to be assigned, it's actually a good thing because then you can avoid assignment by taking more income. Oh, darn. I've got to take more income. Ah, okay. So let's go ahead and close this poll. It's been up for about a minute and a half. And share the results. What 2 things impress you today? Well, let's see. Our winner, look at this, is taking income but still having an unlimited upside. That's pretty cool, isn't it, Mike?
Absolutely.
I don't think anybody that's gone to a weekend covered call trading course picked that up. I know I didn't. I've invested more in my options education than probably anyone on the line. And I'm not trying to be, an elitist or anything like that, but I've certainly invested a lot more time. Having traded these strategies with the married put as a base for 8 years after, getting my butt handed to me in the market. It never happens anymore, okay? Sometimes stocks go against my expectations. Sometimes the whole market goes against my expectation. But guess what? I never get hurt. I never get hurt. All right. Let's see. Second place was taking a stock and bulletproofing it. That's marvelous. Okay, cool. What kinds of questions have you come up with there, Mike? And
well, one question I just got was in regards to how do you identify these types of trades, and I of course told the attendee that Kurt describes his method of stock selection and what he's looking for and why he's using this specific setup in the blueprint. But we also have a default search programmed into the Power Options Married Put patented search screen that is the general starting point that Kurt uses to identify the RPMs he trades in his personal account.
Mike, do you think it'd be of value to our subscribers to take a look at that?
I don't know.
To take a look at the Power Options screening?
I mean, we can, but it's hard for me to do in 5 minutes because there's just so much there, and it's and we can, but I mean, it's just really, there's not a lot we can get into in just the 5 minutes we have left.
Okay, all right, fair enough. What I'll do, are we on the Radioactive Trading site?
That's right.
Okay, let's go to resources here. Okay, we'll go to resources, and on the resources, this page is free. Everything that's on here. This first section here is a link directly to the Power Options tools and a free 2-week trial. Okay, it's a way for folks to test drive, and anyone that gets this will have the opportunity, Mike, to get with you in a live trading. Live training session. Is that right?
Absolutely. Mm-hmm.
Okay. Does that cost anything?
No, it's absolutely free.
Okay, and you'll be able to take a look at a platform that'll show you the exact platform that I use to select my trades.
Mm-hmm.
Okay. The Trade Simulator tool, we might have a moment or two. Well, I don't know if we got enough time to cover that. What do you think? Maybe we could cover that.
Mm-hmm. If you wanted to.
Yeah, let's do that. Okay.
Well, we also have several questions here that we're getting through.
Let's handle the questions. The questions are probably more important.
Okay. All right. Well, Mendy wanted to know, does the blueprint have formulas or spreadsheets you can use to figure out the best way to manage your trades and the income methods?
Yeah, we have something called a decision grid, and it's going to have something to do with your temperament, okay, and your goals, and it's going to also have something to do with the current status of your trade. Okay, if you've bought a stock and bought a put, and now that stock is trading higher than the put strike, well, you might want to choose between income method 3, 4, and 1. Okay. On the other hand, if it's below the strike price, you might do income method 6, and so on and so forth. Okay, but there's a decision grid. I think that answers the question of the caller. Okay.
Hari wants to know, do you trade on margin? Can you ever trade on margin, especially portfolio margin?
I don't use portfolio margin until I'm bulletproof. For example, let's say I've got $100,000 in my trading account, and my stock plus my puts are worth more than $100,000. Then I might use margin to open one more small, say $10,000 per position. Why? Because I'm guaranteed back more than what I've got into the trades. As far as opening a trade, do I use margin? Never. Never, ever. Why? Because it negates the limited risk that I have determined that I'm going to start off trades with. Okay? For example, if you've got 6% at risk in a trade, and you borrow half of the money to do it, then that's actually really 12%, isn't it?
That's right.
So it just negates what you're trying to accomplish. So short answer, no. We don't do that. Mike, I'm going to launch one more poll for the folks that said, do you remember this poll here? If you could keep your wins from the last 12 months, but your losses were limited to only 6%, would you have answered that you're happy? Okay. I'd like to do a follow-up question to that. Could you put a dollar amount on how much better you would have done? Do you just not get it? We actually have had some people say, I can't see that forcing myself not to lose too much would even help. It's like, oh, okay. Good. But we've also had folks say, hey, you know, that would have meant $300 to me, that would have meant $1,000 to me, that would have meant $5,000 to me, that would have meant the opportunity of a lifetime to me. You know, we had some folks in October, November of 2008 write in and say, hey, I've got 94 of my 100 marbles still in my account.
Time to buy.
Thank you. Yeah, exactly. And they were able to buy at the bottom. So, okay. Mike, I'm going to go ahead and close this poll and share the results. Okay, adding that up real quickly, it looks like it adds up to 99%, but I think that's because of rounding off in the poll system. You know, it doesn't go into decimals. Okay, so 8% would have meant $300 to them. 33%, that's a third of our audience. You'd be ahead by $1,000 to $5,000 almost. and 50%, the lion's share, most of our subscribers today would have saved or made $5,000 or more. Or had minimal losses and been able to buy at the bottom. Isn't that something? Okay, Mike, would this information be worth something to somebody if they could, gosh, have a time machine, go back 12 months, and then start over?
Oh, are you asking me, is $289 worth saving $5,000? I think so.
Oh, yeah. Actually, what we've given away for free today is worth $5,000 or more.
Just about, yeah,
folks. Yeah, if you'll practice it. Okay, if you'll practice it. It's not sexy. The idea of buying insurance for your stock seems a little stodgy, doesn't it? It seems a little conservative. Okay, but guess what? If you'd have done it last year, you'd be ahead by $5,000. So maybe let's make the decision that if I was to ask you the same question a year from today, you'd give a different answer, right? Maybe you'd say, yes, I'm happy with my trading. Okay, and yes, of course, the blueprint. We're going to flash the blueprint up there and the costs. Like I said, we give away the very best thing in these free sessions, but we also showed you two things that I think are even better if you have the knowledge of both. And that is the income methods. If you have the knowledge of how to limit your losses in the first place and how to use the income methods to bulletproof your trade and still take income, that's worth something, isn't it?
Yeah, now while you show the blueprint and you're on that topic, I wanted to bring up the other question that was asked by Ashley. Do you make money if the stock does not go up? Every example you showed, you did income methods when the stock goes up. What happens when the stock goes down?
Mike, I've got an answer for that, but you've got an even better answer for that, don't you? Because you've actually done that better than me.
There are...
you want to talk... Is it your Office Max position? Or
it was Office Max. It was Office Max. It was my first RPM I ever opened about 2 years ago when we first started working.
What's an RPM?
Well, RPM
What's an RPM?
It's a radioactive profit machine. That is Kurt's term for this unique form of the married put position because we're taking advantage of the, I should say, taking advantage of the non-time decay of that far out in time put option that's deep in the money. But I got into Office Max at around $20 per share, and I had, I think, a 22.5 strike put on the position that was several months out in time. 4 months into the position, 4 or 5 months into the position, Office Max was trading at $5 per share. Now, as the stock had moved down, there are income methods that you can use when the stock declines in price, and also if the stock just stagnates, right, Kurt? Income method number 8 can be used if the stock's just stagnating there to generate some income and lower the risk. But I had used income method number 9. I had made some other adjustments on the position based on the blueprint. The stock went down to $5. It came back up to around $8.50, $9 per share, and I was able to liquidate it for a gain even though my cost basis had originally been $20.
Okay, so you spent $20. The stock goes to $5, comes back up to between 8 and 9, and you made money.
I ended up closing it for a profit. Now, it wasn't a sexy profit, but I was down over 50%, and I still made a profit on the position.
Yeah, I think making a profit when your stock is down 50% is sexy. No matter how you slice it, you can. Yeah, no matter how you sell it, there, Mike. That's something else. That's really good. Okay, so that should answer the question from Ashley. Let's see, Mike. Are you viewing the poll?
Yes, I'm still looking at the poll about what we'd like to know next.
Let me close it. Okay, 20% would like to know more about the blueprint. 30% would like to know about the Foundations of Radioactive Trading CD, and our winner, like their own free copy of the Trade Simulator tool. Oh, it tied with the Power Options Search and Destroy platform. Okay, Mike, because we're out of time, I'm going to go ahead and show how to do those top 3. Okay. All right, the Foundations for Radioactive Trading CD is on the same page as the blueprint. It's $89, and I said that I was going to show a bulletproof trade, and I did. I mean, a riskless trade, and I did, didn't I?
You did, absolutely.
Okay, here's another riskless trade, okay? If you pick up the Foundations of Radioactive Trading CD, which tells you how to set up your own RPM, the rules for portfolio management, what we call the holy grail of trading, okay?
Mm-hmm.
And the definition of expectancy and how you can use it to know how much you ought to put into each trade, why then it's $89. If you pick that up and you're not happy with it, you just let us know, and you get your $89 back. Is that a bulletproof trade or what?
That's a bulletproof trade, isn't it?
That's right. Now we can't do that because it's a CD. You know, we can do that with the CD. We can't do that with the Blueprint. The Blueprint is a bound manual. It's over 250 pages.
Mm-hmm.
You know, if you buy it, hey, look, you're on the hook. Okay, you bought it. All right, but that's the Blueprint. Look, if you want to get the whole deal and learn all 10 income methods and also have everything that's in the Foundations of Radioactive Trading class, why then you'd opt for the Blueprint. But the Foundations class I highly recommend, and it's bulletproof. Okay.
Real quick, Kurt,
Right.
One thing I want to mention,
Yes.
and then I'm going to want you to do something too. If you have questions about the Power Options tools, here you go, Kurt. You can sign up for it here. There's a link to the 2-week free trial. And you can call me anytime if you're a trial member or a subscriber, and I can walk you through the tools on the site. But there are also several webinars that are archived in that free webinar section that discuss using the Power Options tool specifically for radioactive traders.
Power Options for Radioactive Traders. There we go.
Yeah. So you can
Very
access
good.
that at any time when you have free time. But yeah, if you sign up for that 2-week free trial, give me a call, schedule one of the coaching sessions. I'll show you how to use the tools and talk about the methodology with you and the benefits of trading radioactively. Absolutely.
Very, very good.
Now, Kurt, did you want to address, we had a question from Harry here that came in. Do you want to talk about the Fission subscription? He wants a little bit more about what Fission is.
Okay. Let me go ahead and we'll make that our last question, okay?
Very good.
Because I want to respect the time of folks that are on the line. Let me go ahead and sign into the Fission account.
Mm-hmm.
And if you are a Fission trader or a Fission subscriber, you'll be given your own username and password. You can go in and take a look at the track records, okay? Here's track record.
Mm-hmm.
The Fission portfolio, the Ernie portfolio. Ernie is the owner of Power Options, and he's made his trades public.
Mm-hmm.
The plain vanilla portfolio doesn't use real money. This is and it only uses income method number 1. Okay, but as a Fission subscriber, you get to see all 10 income methods that I'm applying in real time with real money.
Mm-hmm. This is your actual account. This is what you have in your actual account right now.
That's correct. Actually, what I'm doing is looking at the track record right now.
Mm-hmm.
Okay, so for example, recently I got out of Medco Health. It had a 4.1% loss. I don't like 4.1% loss, so I took a 1.4% loss. All right. Same thing with Research in Motion. It had a 9.2% loss. I made mine a 2.6.
And we should point out something there for those of you that
Yeah.
may have been joining us and not seen previous emails. That Research in Motion trade was part of your DARE campaign, I guess to say, because you were going to compare, okay, who's going to put up with this, who's going to go online and go toe-to-toe with me. I'm entering RIM right before earnings as a married put, and if you did a covered call, you'd have this at risk, and if you did a long call, you'd have this at risk, and then you showed the results of who actually came out on that position ahead.
That's right. And nobody's taking me up on that challenge. Here, Mike, we've got all the positions I'm currently in. Cree Research is bulletproof with earnings coming up a week from yesterday. Netflix is bulletproof with earnings coming out a week from now. So essentially, I can't possibly lose. I began this trade on March 23rd. About 4 weeks later, it'll be the earnings announcement, and we'll know if I made 2.6%. or if I made a lot more. And right now, it looks like I'm going to make a lot more. Same with Cree Research. We're going to know here in another week if I made 1.9% or if I'm going to make a lot more. Okay, and all these other positions are not bulletproof yet. Big lots, for example, I can still lose 4.1% if something terrible happens. Although big lots is up. Same thing with Kinetic Concepts. 5.8%, and I've gotten back into Research in Motion. We in fact we entered that position live during one of these webinars, and that position that we entered is up. It's still up. Hopefully, it will continue to be up. But whether it is or not, I can't possibly lose more than 6.8%. Okay, and very likely in practice less than 6.8%. Got her?
Got her.
Okay, gang, thanks for coming out. Hope I answered your question, sir, about the Fission subscription. I should mention that if you pick up the blueprint, that the Fission subscription is
$10.
$10 for the first month. Okay, and you can use that any time that you wish. You don't have to do it right away. You can use that later on after you've read the blueprint and had a chance to digest the material. So, very cool. Okay, Mike, I'm going to go ahead and close this up. We're only 10 minutes past the hour, which is good. I'm going to thank everybody for coming, and remember, you can see us here every Tuesday and Thursday at 10 o'clock Mountain Time. I guess it's 12 o'clock Eastern Time.
That's right.
And Mike and I will be here sharing another facet of the Radioactive Profit Machine. And we'll see you out there. All right? Happy trading, and bye for now.
Take care, everyone. Bye-bye.